Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everyone, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Barings BDC's President Matt Freund. Barings BDC primarily makes debt investments in core middle market companies. On the show, we discuss the recent choppiness and negative sentiment in the private credit market, the effect of declining base rates on yields and credit conditions, the current deployment opportunity set for private credit funds, PIK loans and portfolio construction, and more. So with no further ado, here's our show, A Strategic Lens on the Private Credit Environment with Barings BDC's President Matt Freund.
Matt, welcome to the show. How are you doing today?
I'm doing well, Julian. Doing very well. I'm happy to be here.
Yeah, excited to chat about Barings BDC. We'll call it BBDC for the sake of the show today. But prior to getting into that platform specifically, could you give us more of a broad overview of Barings and how the BDC fits into the firm's credit platform? Because I understand it's a very kind of large and well-diversified platform you have there.
Yeah, thank you so much. I'm happy to give a little bit of an overview on the firm. And so Barings is a majority-owned subsidiary of MassMutual Life Insurance Company. For those that don't know, MassMutual is one of the largest life insurers in the world. And Barings serves as a subsidiary providing both strategic investment opportunities as well as a really compelling source of return for underlying MassMutual policyholders. As we think about kind of the structure of the firm, in addition to being majority owned by MassMutual, we also have a number of third-party clients that are coming to us to provide similar investment solutions across different asset classes, be they liquid fixed income, illiquid fixed income, real estate, real assets, and the like. And so as you think about what makes us unique and what differentiates us, in a landscape of choice with a variety of different managers that you can choose to help you achieve your investment objectives, Barings has an ownership structure that really sets us apart. We also think that whenever you compare ourselves to publicly traded asset management peers or a long list of competitors that might exist in fixed income markets, we have a really unique value proposition that is difficult to replicate.
Makes a lot of sense with the aligned incentives. You always want to see that as a capital allocator. Now, I wanted to touch on the current credit market environment for context for our listeners. December 1st, we've had a few kind of rocky, call them volatile months, some negative headlines in the credit space, so to speak, and that's created a bit of sentiment weighing on the sector, specifically the traded BDC space, and we have had some volatility there. What are your thoughts on the current market environment and the volatility that we've seen lately?
Yeah, Julian, it's a great question. And there's a lot of components to it and a lot of different layers that I think you need to understand. First and foremost, private credit as an asset class has really grown tremendously over the course of the past decade. While it has operated in various forms and fashions for the better part of half a century, I do think that it's important to acknowledge that it's really only caught on in the mainstream understanding of an investment opportunity over the course of the past 10 years or so. And one of the reasons that we spend a lot of time looking at public BDCs is because they are one of the most easily accessed strategies for an individual investor to deploy into a private credit opportunity set. And so your question, I think, is spot on in the context of recent headlines and why they have been getting attention. I think that there are a couple of things that need to be understood. One is that because the asset class has grown so much, I think that there are opportunities and situations that are being branded as private credit that may not really reflect how individual investors think about private credit today. And so I think that's really important. There have been some high-profile bankruptcies recently that have been branded as private credit investments that I think individuals in the industry would probably contend that is otherwise true. And then the other piece of your question is as it relates to the sell-off in liquid traded BDCs. Over the course of the past couple of months, what we've observed in the marketplace is that there has been some selling pressure on public BDCs. We believe that a lot of that, or at least some of that, is due to anticipated interest rate reductions as investors are evaluating getting out of what is a floating rate asset class. And so as you think about what is really being delivered to investors, it is a floating rate asset class. And as the SOFR rate or the base rates are expected to come down over periods of time, we believe investors are kind of trying to time their trades to get out prior to a reduction in base rates. Importantly, we do believe that there's compelling relative value to be offered. And so, like any other liquid stock, there can be periods of selling pressure and periods of buying opportunity. It's really up to an underlying individual to figure out which one this presents today.
Yeah, and it's interesting, if you look at relative yields in the BDC space, they've actually increased despite some rate cuts flowing through the income statement there, even as... go ahead.
And that's a super important point. I think that, the benefit of liquid BDCs is that you can get in and out daily. And that's the huge benefit of that particular sector. But to your point, I mean, if you're buying into a security and it has an effective dividend yield in the 10, 11, 12% range, and you feel like you've got limited degrees of downside risk associated with the price of your stock, then I think that you can ultimately find a really compelling opportunity to invest. That's, I think, where we are seeing some investors get very active in the public BDC ecosystem is seeing these elevated yield levels and feeling like it's a compelling opportunity to buy.
Yeah, and there's positives and negatives. You mentioned benefits. Now, yields are coming down. Obviously, BDCs are a floating rate instrument, as are broadly syndicated loans, T-bills, etc. But with that decline in interest rates, your portfolio companies should theoretically have a better credit profile with respect to interest coverage ratios and things of that nature, and the ability to service that debt as their interest rates decline with the Fed funds rate. Now, with that, given the recent rate cuts and the decline in short-term interest rates, have you seen improving credit conditions in contrast to the decline in yields? To sort of, I'm trying to get at, is it a balancing act for investors? You have some gives and takes there.
Yeah, I think that it's a great question, and it's a very important one. You made reference to kind of different opportunities for investment in a floating rate environment, right? And so like the risk-free option is, of course, cash or a CD, and we all know that cash has been yielding, call it 400-ish basis points plus or minus for a period of time. The liquid loan markets offer, call it a 200 to 400 basis point premium over that, and so you can kind of just stack that on top of your risk-free rate. And then the illiquid credit markets, which is where we're really spending a lot of time and opportunity, add another 150 to 300 basis points on top of that. And so as you kind of continue down the credit risk spectrum and the illiquidity risk spectrum, I think that you start to you can juxtapose what your primary considerations are as an underlying investor. To your point, as you think about like the trade-off between a reduction in absolute yields, which is exactly what we're talking about. We're talking about interest rate. If the secured overnight funding rate goes from 4% down to 3% as a direct consequence of Fed activity, that reduces the yield that the investor gets by 100 basis points. Like it translates directly into kind of the yield charged to the borrower and then the yield that the underlying investor is, of course, paid. But your point is very important. That in theory, there should be a unit of reduction in risk because that cash flow leverage or the amount of cash flow that's required to service the debt that the issuer is paying, in theory, should provide a greater stability of cash flow cushion should the economy enter into a weak period of economic contraction or any other variable. And so as we think about the interplay between these variables, I do think it's very important that folks keep in mind that, yes, as interest rates do come down, it is not a zero-sum game. It is not only a reduction in income that is available to you as an investor, but it also does provide a measurable reduction in the risk of the underlying portfolio. And so as you think about building diverse portfolios for yourselves or for other purposes, I do think that seeing a reduction in interest rates, while will have a negative return impact to your portfolio, should also have a positive impact in the context of reducing the overall risk of your portfolio.
That makes a lot of sense. And then when you look at the recent volatility that's resulting in the widening of NAV discounts right now in the BDC space, when you look at the capital allocation for your BDC, how do you think about share buybacks in these market conditions relative to the other opportunities for deployment?
Yeah, Michael, it's a great question. And it's something that we consistently reevaluate and evaluate. We do have a standing authorization from our board to execute open market purchases on a buyback of our common stock. And we do regularly evaluate that. I think that whenever you start trading at certain levels, it becomes hard to ignore, only because it's really, really difficult to make an incremental investment in a new underlying investment opportunity that has a similar return profile as buying back shares whenever they trade at a certain discount. At the same time, there are other pieces of the puzzle that you have to balance. One being the overall strategy of the fund itself, and then leverage, of course, is an important consideration. And so, all in all, we do think that it is an important tool in the kit, but of course not the only tool in the kit.
I do want to dial into BBDC's lending strategy and was wondering the reasons behind the focus on core middle market lending, specifically that is targeting or lending to private U.S. companies with EBITDA of between 15 million and 75 million. What do you find appealing in terms of those types of portfolio company loans?
Yeah. So as we think about framing up the investment opportunity and where we want to spend the majority of our time, we talked earlier about kind of building up the return profile at the asset level. And I talked about the risk-free rate, and then you add a credit risk premium to it, and then you add an illiquidity risk premium to it. And if you think about those three constituent parts, that's really where the majority of the return from our asset class is coming from. And so it's the risk-free rate plus the credit risk plus the illiquidity risk. And as we think about framing up kind of underlying investment opportunities, we think that the most compelling risk-adjusted return, we think the most compelling illiquidity premium can be really found in that $15 to $75 million EBITDA segment. In our experience, issuers with 15 to 75 million of EBITDA tend to have strong credit protections that are afforded to the underlying investor. And at the same time, they have a degree of return that is also more compelling than what you'd find in the larger end of the market. It's not to suggest that we think that large companies are bad places to invest. It's just so happened that whenever we allocate our time, we think that an issuer with 50 million of EBITDA has a better mix of structural protection and underlying return characteristics than an issuer with 250 million of EBITDA. It's just going to have a very different set of calculus whenever it comes to the return characteristics and the structural protections.
So in terms of core middle market versus some of those larger upper middle market loans, is there a trade-off with respect to risk? Is it valid to say, 50 million is riskier than 250 million EBITDA loan, or can you offset that with a documentation or covenants or other aspects to your lending strategy? What are your thoughts on that dynamic?
Yeah, look, I think that every transaction is going to be negotiated with different characteristics associated with risk as well as structural considerations. And that is absolutely true. So I wouldn't want to understate the importance of the uniquely negotiated relationship between the investor and the underlying issuer. At the same time, I think that if you take enough data points in the ecosystem, what you would come to find out is that very large issuers tend to have higher units of financial leverage. And so that's leverage levels that the borrower actually bears. And so that's debt divided by EBITDA, than what we would find in the core of the middle market. And then I feel like that's pretty systemic in terms of when you evaluate portfolios of large cap issuers against portfolios of middle market issuers. And so while you may have different structural protections and you may have different covenants and different forms of required documentation, at the end of the day, financial risk on large market issuers tends to be higher than the financial risk that's embedded on the middle market issuers. And I'm using financial risk to mean the balance sheet leverage levels relative to the earnings profile.
That makes a lot of sense. Now, with respect to the current market environment, we have seen an uptick in M&A activity, which is, one of the core drivers of deployment in private credit. Granted, a big portion of the uptick have been announced but not yet closed deals or very large leverage buyouts that will likely tap the broadly syndicated loan market, or perhaps a mix, including private credit as well. What are your thoughts on the current deal activity environment, M&A, leverage buyouts, private equity activity, and is that resulting in more deployment opportunities, deal flow, and what are the effects on spreads, if any?
Yeah. And so the majority of the deployment opportunities that Barings sees are going to be in the sponsor-backed lending ecosystem. Julian, you made some references to the fact that kind of leverage buyout activity, merger and acquisition activity is a very relevant data point as we think about opportunities for capital investment here. And you are spot on in terms of your interpretation there. Over the course of the past couple of years, we have seen private equity portfolios elongate in terms of the number of years that these private equity owned portfolio companies have been in private equity portfolios. And it's because they just haven't chosen to exit them yet. And as a consequence, that has created what is perceived to be a pretty significant backlog of opportunity in the proverbial system around unsold and unmonetized private equity holdings. Over the course of 2025, we've heard more and more rumblings around the proverbial dam starting to break, and that we're going to see more and more M&A opportunities and activity pick up. Unfortunately, broadly speaking, that has not been the reality. What we have seen is that there have been a handful of very large transactions that have driven kind of the dollar deployment statistics. We spent a minute talking earlier about the difference between the core middle market and the upper middle market. And there's a lot of truth to the fact that the upper middle market has seen some pretty significant deployment numbers, but it's really been driven by only 2 or 3 transactions. And so as we think about the core of where we're spending time, and I think the core of how people think about private credit, it has been a successful year. It's certainly higher than it was in 2024, but I don't think that I would call it a banner year. It's not as though we've seen a flood of opportunity that has been prognosticated. It's our kind of institutional perspective that we're going to continue seeing incrementally more opportunities as time goes by, but it's difficult to identify any form of catalyst that's going to really change the velocity of opportunities like a COVID era event did, or like a GFC era event did. It's just going to be a steady and measured incremental growth until we see some kind of broad market event that honestly, I'm not sure anyone can articulate what it will be.
And then moving beyond the kind of your core business and sponsor-backed lending, you also have platform investments, which would be, I guess, described as litigation finance and other asset-based lending. That's about 5 to 10% of your portfolio. Can you share a little bit more about what this space is and why it's attractive within the BDC's portfolio?
Yeah, Michael, great question. And so we think about lending in a variety of different formats. And so the vast majority of the BBDC portfolio is going to be in cash flow lending. And so we are lending to a business based on the underlying cash flow characteristics of that business and the corresponding enterprise value of that business. And we're doing so typically in an investment with a private equity firm who's making an equity investment in the underlying company. And that's the vast majority of how we think about lending in our cash flow ecosystem. We have a belief, however, that that's not the only attractive way to lend to companies in the corporate ecosystem. And so whenever we think about making an asset-based loan, we do so through our wholly owned subsidiary, Eclipse Business Credit. Eclipse Business Credit is a business that is actually lending on the liquidation value of accounts receivable and inventory. And so as you think about how we position that portfolio, it has a separate governance structure and a separate management team, and it is a dedicated strategy. And what they're doing is they're ultimately assessing the collectability associated with the underlying assets, which provides a really counter-cyclical element to the underlying exposures in BBDC and other portfolios that have investments in Eclipse. And so as you think on the one hand, the cash flow portfolio performs very well in its own right. Whenever we enter into a period of economic weakness, an asset-backed portfolio provides a buttress in terms of the overall return profile of the broader strategy. And Rocade does something very similar. And so Rocade is actually lending against the net early liquidation value of the associated legal claims. And so they're a litigation funding solution. And so to the extent we are looking for uncorrelated exposure relative to cash flow lending exposure, that's really what these portfolios of assets will do in the context of their investment profile within BBDC.
And within that litigation finance bucket, just given the nature of the differentiated cash flows, which would be unique vis-a-vis traditional cash flow business,
Yes.
Is that segment where you would find increased use of payment in kind loans?
So yes and no. Each loan is going to be kind of structured independently, and it's going to be based on the underlying cash flow characteristics of the law firm. And so as you think about what that platform is doing. They are lending capital to help law firms effectively work through very, very long lead time for cases. We're not doing, it's not the proverbial ambulance chaser. It's not someone who's filing a claim that's hoping to, fix a broken leg or anything of that sort. These are people that are working through very large claims that you've probably heard about on the likes of CNN and what have you. But in any event, the structure of those loans, it is often going to involve a form of cash interest payment. It may or may not include a form of PIK optionality associated with the loans themselves. It really depends loan to loan based on the underlying cash flow characteristics of the cases, as well as the way that the law firms are kind of structuring to recuperate the capital that they've invested in the case and claim itself.
Now, in the current market environment, it seems like there's been more investor attention and consternation regarding PIK loans. Do you think that's misguided?
It's a great question. And so kind of taking a step back, we were just speaking a moment ago about Rocade and the fact that it is an asset-based strategy that's really focused on litigation finance. As we take a step back and we were talking about the cash flow lending nature of the majority of BBDC's portfolio, I think it's fair to say that the vast majority of BDCs out there are focused on cash flow lending today. That's where a majority of BDCs spend a majority of their time. PIK interest or payment in kind interest, as you just articulated, is becoming more of a focus. And I think that the reason that it's becoming more of a focus is because we're talking about marrying cash flow portfolios with payment in kind interest. And so at some fundamental level, I think that people have a perspective that if you've got a loan that should be structured to service debt on a cash flowing basis, that if you're not actually servicing that debt using cash flow, if instead you're just accreting the interest to your loan balance, it feels like those two facts are a little bit at odds with each other. And I think that your listeners are spot on, that they are appropriately skeptical of having PIK income in a portfolio filled with cash flow loans. That said, I do think it's really important to understand a manager's strategy. There are managers out there that actively pursue deploying capital into opportunities that are going to have PIK features associated with them. There are other managers that very much avoid investing in assets that have PIK features associated with them. And so it really depends in terms of how the manager has decided to angle their strategy as to whether or not an increasing percentage of your loans having a PIK functionality to them is really a concerning or a less concerning development.
Right. And from a manager's perspective, is that an opportunity to increase yield, perhaps, increase return?
It certainly can be.
Right.
It certainly can be. I would say we have seen opportunities over the course of the past year where there is no premium associated with the capacity to PIK an underlying security, at least not as we see it. At the same time, very often, whenever the optionality is included in a document that an issuer can PIK a portion of the margin, there's usually a spread pickup associated with that margin being PIKed. At the same time, you could ask yourself, is that incremental unit of PIK margin really accommodating the incremental degree of risk that might be accompanying that election to PIK? Every investor and every manager is going to have a slightly different perspective on that.
No doubt. And one interesting aspect about BBDC's portfolio is it's one of the most broadly diversified in the BDC space. Can you discuss your approach to portfolio construction?
Yeah. Look, we are pretty big believers at Barings that diversification is the only proverbial free lunch. It's been kind of our anecdotal observation that the largest loan you make is often the one that's going to go sideways. Of course, that's intended to be tongue-in-cheek, but it's an axiom that will prove to be true at the least opportune time.
We have seen a bit of that this year at other BDCs, unfortunately.
Well, there's a reason that sayings become popular. And so I think that one of the observations that we've had is that if we can run granular and diversified strategies, ultimately, should we experience a hiccup, it's not going to be one that is fatal to the overall vehicle. And so as a consequence of that, look, we fully acknowledge that we're never going to we don't get it right 100% of the time. We would position that no one does. Nobody bats 1,000 in this industry. And so whenever you do inevitably lose some amount of money, you want to make sure that the amount of money that you lose is a very measured amount, because it is kind of the risk premium we talked about. You are eventually going to lose money if you lend enough of it. But making sure that your individual position sizes are sufficiently small will help kind of buttress any sort of challenge that you have in your portfolio. And so we like to implement that strategy in the context of BBDC and ensure that the position sizes are very granular, ensure the position sizes are very defensible. And should we ever experience any volatility in the underlying portfolio, it's not going to be so severe that the overall portfolio is going down to perform. We do have the benefit at Barings. We have a large and scaled origination franchise that is able to source a variety of opportunities across the credit landscape. We utilize that in conjunction with our discipline around position sizing to ensure that we can optimally position the portfolio for underlying investors.
It's often said diversification is the only free lunch in investing. Now, with that said, there's been increased attention and growth within the BDC space, particularly, there's the non-traded versus the traded. But what do you think public market investors perhaps misunderstand, or what do you wish that they could better understand about the BDC sector as a whole, or BBDC in particular?
Yeah, I think that investors have a lot of information to evaluate these pools of loans, much more so than they have for the past, 10, 20, 30 years. It feels like the amount of disclosure is pretty meaningful and that people can actually get under the hood and look at these positions. I also think that the industry has done a great job in terms of just continuing to evangelize the investing public and helping people understand what's going on from a strategy perspective, from an asset perspective, from an overall investing perspective. And so I do think that as the asset class of private credit has become more mainstream, and as BDCs have continued to become more and more accessible in different formats, as you note, with the perpetual private strategies as well as the public strategies, I don't know if there's a lot more that I would encourage people that they, quote, need to understand, but there are certainly things that I think you should understand for any investment. You should certainly understand a manager's underlying strategy. You need to understand the manager's underlying alignment. You, of course, want to understand the fee structure and how it works in a good market and in a bad market. And I think that if you work through those diligence efforts, you're going to have a pretty firm understanding of the underlying risk that you're taking on. Whenever you think about investing in BDCs, I would say a very important consideration is the liquidity features that you expect as an underlying investor. The big benefit of public BDCs is that you can buy them. Many of them are listed on the public stock exchanges. You can buy them today and you can sell them tomorrow. And so if your investment horizons change or if your investment needs evolve, you can very quickly and tactically reallocate that capital from your account into a different format. And that's the big benefit of the public strategies. The perpetual strategies and frankly other forms of closed-end investing in private credit, they have different liquidity features. And as a consequence of having different liquidity features, I think it's very, very important that investors understand the time horizon that they have to allocate to the underlying asset class. Because we are originating loans with a 5, 6, 7-year duration. And whenever you have a duration of 7 years and you have a product that's accessible on either a daily or a quarterly cadence, it does create the possibility of a mismatch between assets and liabilities in the context of fund performance. And so there are features, of course, designed in these products to prevent any form of mismatch. But I do think that it's important that investors understand that, because I do occasionally wonder if everyone that's invested in the asset class does understand the nature of the liquidity features that are available to them.
I think you're right with respect to a lot of the feedback that we receive from investors. Now, you did mention the enhanced transparency and disclosures of BDCs, which are ultimately a positive benefit. But with that enhanced transparency does come more attention and more eyeballs, specifically on fair value marks, call it, of loans. And you are seeing some loans that were somewhat, syndicated across multiple BDCs, and in a potentially distressed or stressed scenario, they end up with different marks. What are your thoughts on that dynamic? And, is it valid that the media has a somewhat negative view of that?
Look, I think that anytime you're dealing with investor capital, it's important to understand the valuation processes associated with your marking strategy. And so to the extent that there are more eyeballs on it, I do not feel like that's a negative fact. I do think that it may at sometimes create some confusion because for every reporter that we've heard that cites some of the kind of the inconsistencies of it, there's often one or two that are kind of trying to highlight a perceived inconsistency that may not actually exist. And so I do think that understanding the severity and the magnitude is important. We welcome folks to review our valuation information because, candidly, we think it's better for the industry. We don't think that valuations are things that should live in the shadows. We think that valuations are things that should live in the light. And as a consequence of that, everyone should feel more comfortable and confident about the information that's being published. Invariably, at Barings, we have third-party reviewers. We have a third-party valuation team internally. We also have an external valuation consultant that we use to kind of review and reconcile all of our data points. But these are illiquid assets. And so it is not impossible to believe that you might see some minor variances between what one manager has a mark at and the second manager has a mark at. And in the context of comparing manager to manager positions, I think that relative size is important. And so if you have a manager that marks a position at 98 and you have another manager that marks a position at 97, as Julian, you noted, that's a difference. It's not the same, but it's a very small difference. And I would argue that, in the context of, is there anything really substantively different in those positions? Arguably not. I think that where the questions become a little bit more interesting is whenever somebody has a position marked at 95 and somebody else has that same position marked at 65. Clearly, that variance has a substantively different fact set that managers are applying in terms of determining their underlying valuation. And I think that it's very rational that investors are asking questions how such a meaningful disparity could occur. Of course, they need to spend time with the manager and ask those questions. And if they don't get the answers that they want, they have to formulate their own opinions. But I do think that that's a very rational train of thought that someone investing in the space can absolutely pursue.
And one last one, Matt, before we let you go here. Private credit as an asset class really has just come to the forefront over the past decade or so and has grown tremendously. What do you think's next for the private credit industry, BDCs in general, and BBDC in particular over, call it, the next 5-10 years?
Yeah. I mean, look, I think that with respect to BBDC, our focus is to deliver compelling relative value for our shareholders day in and day out. We look at this as an opportunity to provide an illiquidity premium for accessing a unique area of the credit landscape. And as a consequence of that, we think that delivering a risk-adjusted return that's, 200 to 300 basis points outside of what a liquid market opportunity would provide is really the base case for what we're trying to deliver with a reasonably low unit of volatility. That's our hope and our goal. I think that for the asset class more broadly, I think that we would like to just continue to see additional market acceptance of the asset class. And I think that as we continue to see evolution of some of the different manager strategies out there, over the course of the next 5, 10, 15 years, there will be manager segmentation. We feel reasonably confident about that. There are folks that have probably grown faster than they expected and now have a surplus of capital. There are probably other folks that may have a slightly more aggressive credit strategy. As a consequence of that, whenever a credit cycle happens, their portfolios will react accordingly. And so I think our broader kind of thematic perspective is that we look forward to seeing the asset class continue to perform and provide value as it's intended to, but do acknowledge that there could be some evolution in the market constituents along the way.
Great. Well, thanks very much, Matt, for coming on the show today, sharing your key insights on private credit and Barings BDC. So we wish you the best of luck in the future.
We really appreciate it. Thank you so much for the time, guys.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.